Hello everyone, this is Ankur from FinStudy Club. Welcome to the last study session, which is study session 7 for CFA level 2, for the financial reporting and analysis. Now, this is a very interesting study session in the sense that it is very easy. So there is hardly anything which is very difficult, from an exam standpoint. So I'm writing the first word, easy. The second thing that is peculiar about this study session is it is very analytical. Okay. The third thing, which I like the most, is that it connects your level 1 concepts very well to the concepts of forecasting, normalized earnings that you've learned in your equity level 2. So this typically is basically the work that you shall perform as an analyst. So no wonder that CFA Institute has been pretty particular in asking a couple of questions, from this. So the study session has got two readings basically. Some substance out of the two is common, but I would like to treat them, pretty separate. Reading number 21, which talks more about the earnings quality, and reading number 22, which is talking more about the techniques of analysis, which is basically, the full case that they've taken, and they've analyzed different ratios out of that. So we will follow the same pedagogy pretty much, you know um, the same sequence. So overall, if I put together, I have about 25 slides, and I think that we should be, home in about 45 minutes. So this is going to make great sense. This is anyways going to make some sense, but it's going to make great sense if you have a calculator with you, because it's going to be pretty hands-on. Number one, you have, let's say, a printout of these slides, or at least you are able to make some notes. That's going to be the best. Obviously my suggestion is, after looking at this video, just look at any book that you're referring to, be it the CBOC or any other notes of Wiley, or any particular thing. So that's going to take not more than 30 minutes to just scan through. So what I've done is, each paragraph from core book, or different notes have been taken, summarized, and has been presented pictorially. So welcome again to this study session 7, and I'm going to quickly start with the first of the readings here, which is reading number 21. Yeah, so here it is, reading number 21, which talks about the evaluation of the quality of the financial reports. Now this is something that you've already done in your level 1, the last study session there also, and therefore, a lot of students do not find this very challenging, which is rightly so. A couple of points. So I'm also not going to spend a lot of time on this. A couple of points, need mention here, which is, whenever we talk about the quality of the financial report, we're talking about two aspects. One, the quality of the earnings, and the second is how well is that earnings reported. Different aspects, very different aspects. So the first aspect is very measurement related. How well has the business scenario been measured? The second aspect is, once measured, how well has that been reported? Disclosures, how detailed, and what is the quality of all that. So they're very two different aspects. Obviously it's a matter of common sense that this will precede this. Obviously, first you will have to measure the earnings well, and only then you can talk about reporting that in a good sense. Well, in terms of the earnings quality, we're talking about two things. One, first is the quantity of earnings, and second is the sustainability of earnings. Honestly speaking, like you, I was also a little surprised to find this quantity here. And but rightly so. The context here is that, when is earnings of good quality? So Seaborg has very well explained that earnings can be considered of good quality only when it earns sufficiently enough to cover the cost of capital, in a way that your economic value addition should be a positive number. Because unless and until that happens, the firm will always be under pressure to manipulate that, and obviously, because everyone would like to cover the cost of capital. So that's like the basic hygiene factor that has been covered. The second, and a very important aspect, and a relatively more important aspect, is the sustainability of it. The earnings are said to be of good quality only when a fall or an increase, either ways, is sustainable. If there is a one-time element, in terms of the earnings, then this clause gets defeated, and therefore you have a non-sustainable earnings coming out of that. Talking about the reporting quality, as a second aspect, I'm going to come to this table, which is, very well captures all the scenarios. But before that, it's talking about the reporting quality. Like I said, once the earnings have been correctly measured, you got to talk about the disclosure of it. And when will the disclosure be said to be of good quality? When it helps in decision making. Sometimes you have a lot of assets. I'm taking a very random example from pensions. Your pension assets are 100 and your pension liabilities are, for example, 99. This is a much more decision oriented scenario compared to just this. So plan assets net plus 1. Okay, so if an accountant shows like this, then the reporting quality is not said to be like of good quality. Okay, now obviously under different standards under US GAAP versus IFRS, sometimes a particular disclosure mandate is given. So, for example, in this context, the pension accountant is always told to report the net pension assets like this, but the disclosure that are required in notes to accounts are fairly detailed. There is a reconciliation of PBO, there is a reconciliation of plan assets. If that is not given, and an accountant just mentions plan asset plus 1, then obviously in terms of the reporting quality it is fairly bad. Okay, coming to this particular scenario of the table here, this table very well captures the 4 scenarios that are possible, which are the earnings quality high or low and the reporting quality high or low. Now this is a matter more of common sense, that if the earnings quality is high, then the firm obviously will not be motivated for a bad type of disclosure. Let me just explain, the earnings quality if high, that means there is absolutely a bona fide intention. And in terms of low quality, there is a malified intention on part of the accountant not to show few things. So point I was driving home is, if the accountant is bold enough to report and to measure the earnings well, there is very less chance or virtually no chance that he will be not showing it properly. So this particular scenario is what we practically say doesn't exist. The first scenario, let me just name the quadrants 3 and 4. So the first quadrant is obviously the best scenario that an analyst would like to be, and let me name some companies: Infosys, or let's say Apple. So these are the companies which are obviously strong enough to have only the sustainable part of the earnings without any manipulation as such, and report them in absolutely decision oriented manner. But what is of interest, to this audience, which is you, and to the speaker, which is me, is this quadrant number 2 and quadrant number 3. Quadrant number 3 is easy to understand, honestly. And the moment I'm going to put a name, Satyam, stroke Enron, it will automatically be clear what does quadrant number 3 trying to say. Neither the earnings have been measured well. The policies, etc., that they have used, to calculate the earnings are very, very wrong. And at the same time, the disclosure of that also has not been in terms of a ball of white thing. So there is a lot of malice while reporting, hence we call it a fraud scenario. What is very interesting is this particular quadrant. Okay, it has got a very unique characteristic that the earnings are of low quality, which means they are not sustainable, or there is something which should not have been, but the firm has been very transparent in disclosing that. Let me give you a scenario. Company A needs to supply to company B, who will finally supply to company C. So that's how the chain works. Now the order, let's say, is of 100 units. Some reason restricted A from supplying to B, but that doesn't mean that the B will not honor C's commitment. There is always some kind of a reserve stock in opening stock which B can utilize. Now imagine B was following something called as LIFO, and obviously it's a 20-year-old firm. So in case of LIFO, the closing inventory, as you are aware, is always at the earlier prices. So therefore the opening stock must be coming at 20-year-old prices. The moment those units are sold to C in the current year, the COGS gets billed at these prices, which are extremely low. So there is a one-off jump in the profit. which you and I know as LIFO liquidation. Now, this is something which is non-sustainable. Hence, in terms of the quality, earnings have been pretty bad. But that doesn't mean that the firm is doing it, intentionally. There is a possibility that the firm, in good intention, report that for the benefit of the analyst, gives you the fall, or let's say the rise in the LIFO reserve, as the case may be. Obviously, in this case, will be a fall in LIFO reserve for the use of the analyst, and he can, make a suitable adjustment accordingly. So this is particularly a scenario where the earnings quality is good, whereas, the reporting quality being bad. So that brings me to a very similar table, considering now you have understood the different levels of reporting and earnings quality. I'm going to put 1 here and 2 here, signifying that earnings quality will precede, the aspects will precede the reporting quality. So this first scenario is clearly the best scenario that you would like to get into, and that is your first quadrant that we are talking here. The last scenario, which is both of them are bad, is basically this quadrant, which we have numbered quadrant number 3. And the rest, second, third and fourth, are basically the gray matter between the white and the black, wherein the earnings quality will turn bad, but it is still remain decision useful. That means the firm is still bona fidely explaining the scenarios, etc., to the analyst. In the third and the fourth, now the firm has also started to deteriorate its reporting quality. So this is again like turning towards a worse scenario. So moving to the next point, which is considering the two broad problems of quality of financial reporting. The first, and a very easily understood, is the timing issue. The second one is also pretty simple to understand, is the classification issue. The first, the timing issue, is basically the shifting of an income or an expense between time periods. Okay, we are not changing the nature of it, but we are just, what I'm saying is, we are considering operating as operating, considering non-operating as non-operating, but we are just shifting between the two aspects. And one of the very easy way of doing things is capitalizing versus expensing. Now, if any firm wants to reduce its profits of the current year, rather than capitalizing, they will prefer expensing. If a firm wants to do just the opposite of it, they will prefer capitalizing. So obviously this is a very important line that I want you to read through, that the different combinations resorted to by different companies are as per the different situations. There is no one size that fits all, kind of a scenario. I mean, if let's a firm wants to increase the profit, in the current year, then they would do something else compared to a firm who wants to increase the profit, let's say, in the next year. So there is a lot of permutation combination that the firm has to apply. Same is the concept with cash versus accrual. If the firm wants to postpone the profits for some reason, then the sales that the firm has made, even the cash has been collected, they will show that as unearned revenue. A is equal to L plus C. So cash coming up will not be taken to P&L, but will be shown as unearned revenue, okay, in the current year. And in the next year, this unearned revenue will translate itself into the P&L. Okay, so on and so forth. So there are a lot of these things. The same thing could be done in terms of expenses as well. If the firm wants to reduce the current year's profit, even if the firm would have prepaid rent for the next 3 years, they will not show it as prepaid rent, but show the rent as the current year itself. So obviously the analyst, which has the access, the window for an analyst is only the annual report. These minor details will not be possible for him to catch. The second, and a very easily understood, is a classification issue, wherein we are talking about that if the firm wants to increase his operating income, then they would like to classify non-operating into operating, and they want to classify operating expenses into non-operating expense. Now again, like I said, different combinations will matter. If the firm wants to avoid a merger and acquisition bid by becoming unattractive, they would like to push down their EBIT. How would they do that? The non-operating expenses will be included in operating aspects, and some of the operating incomes will be taken out and will be shown as non-operating. So obviously combination of that will pull the EBIT down. Okay, so these are like the two small problems, very easily understood. Now, a small note on the biased accounting. Now, what is a biased accounting actually? Biased accounting is basically this combination that we have been talking about, where the earnings quality is anyways turned bad, but the reporting quality is just being compliant. What I mean by just being compliant is that it is not violating any standard, US GAAP or IFRS, but it is still not decision useful. Okay, just a small note on that. Herein, what basically we're trying to say that the accounting rules have been complied. We are not violating any principles, but the estimates or the principles that we have chosen are basically to convey a particular picture, which is obviously not the correct scenario of the business. What I mean by that, in IT equipment, let's say a projector, you and I have been mature enough to understand that a projector cannot have a life of 20 years, or maybe even 10 years is overestimate. But if a particular company really wants to reduce his expenses of the current year, or let's say over a period of time they want to lower expense, so they will increase the life of the projector to 10 years. So in a way, the accounting rule have been complied. They are following straight line method and they are rightly calculating the depreciation. But the fact of the matter here is that the estimates of life that they have chosen in context of the asset and the business is really not the correct picture. Okay, this is forcing the analyst to believe in something that doesn't exist by taking the incorrect accounting policies. Okay, the question is, this bias can be spread over what all aspects? The bias, the answer to that is, can be spread over income statement, the balance sheet, and the cash flow statement. Your income statement could be biased, your balance sheet could be biased, between the operating versus non-operating assets, etc. You can still make some manipulations. And cash flows, you can take something out of CFO and show in CFI, vice versa, and all that stuff. So all the things can be biased stroke manipulated. And does the analyst have any way to kind of find this bias? Answer is a big yes. You have so many things as an analyst that you can use to find out if the income statement, balance sheet, and cash flows have been biased. Now, a simple point here, and as a tip, I can give you, being my dear students and analysts, is that anything that you do here is not conclusive. Everything is suggestive. What I mean by suggestive, if there is some kind of convergence, if there is some kind of divergence happening with the peers or industry average, then it not necessarily will mean that there is a fraud in the company. Let me take an example. The gross profit margin of my subject matter company is 10%, whereas the industry average is about 18%. Okay, that clearly tells me that there is some bias on the income statement, because you can't really be, at a GP level, you can't really divert so much. But there might be a particular scenario because of which this truly is true. Now, the fact of the matter is that's where the reporting quality comes into picture. Your earning quality is obviously appearing to be bad, but the reporting quality can play a pivot role. If the company is transparent enough, they will explain you the reason for this. Okay, similarly, this is the cross-sectional analysis, the one that we talked about. You can also have the case of time series analysis, where the company's fundamentals is compared to the previous year's fundamentals. There is a lot of interrelationship of ratios that you can establish. The typical actions like creation of special purpose vehicle, one of the most famous ways of manipulating the balance sheet. If let's say there is large fluctuations every year, then again that is going to sound out. So point I'm saying is, these are all A, commonsensical approach, B, not an exhaustive approach, C, suggestive approach to find out if there is a biasness in the the balance sheet, cash flow, or P&L or not. So coming on to one of the most interesting aspect of this reading, which is the quantitative models to detect biasness. Now let me give you a quick context of who created these models and how did these things come into existence. Well, honestly speaking, if you and I go to meet Warren Buffett and ask as to, Mr. Buffett, when do you consider a company being manipulative? So he's going to give us his thoughts let's say 4 or 5 basic points. So let's say he's going to say the management quality has to be good. He's going to say, let's say the working capital ratio has to be something something. He's going to say like your fixed asset turnover. So all I'm trying to say is he as a individual will have some notions according to which he makes his judgment. So here are two models created by such gentlemen who according to their thought process considered the biasness in different companies. So please try and understand these two models are not the only models in the world, number one. Number two, they are absolutely suggestive. They need to be taken, or should I say, they need to be understood directionally. You don't have to mug up these models, you have to really appreciate, and get a sense of what they're trying to say. Okay, different components and variables in this should also be pretty much clearly understood. So my forthcoming couple of slides are based on thought process of different individuals. So there was one such model called as Beanish model, which tried to talk about something called as an M score. Now it doesn't really matter if it's an M score or an N score or a P score. It is the output basically. Okay, and this output is based upon 8 different ratios: your DSRI, your GMI, let's say gross margin index, asset quality index, so on and so forth, depreciation index, selling general and administrative index, accruals, leverage, all that stuff. So what I'm driving home is this gentleman thought that the biasness could be understood based on these 8 variables. Okay, now obviously if you and I start arguing on it theoretically, we can always come out with the 9th variable, or we might reduce this to 7 variables. Now so let's not get into all that. Let's try and understand what it is saying. Is basically trying to say is that he's saying that in the current year, by looking at the previous year's figure, you can find out whether the biasness has cropped in the current year or not. So basically he's trying to say is that every year the situation has to improve or has to remain stable. If it starts to deteriorate, then you can assume that there is a biasness in the system. And the model that he created, obviously he would have used a lot of regression and all that stuff. The greater the score, the worse it is for the company. So the company is a good company like Infosys will have a very low score in that sense. Okay, that's how you got to remember this Beanish model as. Let's try and understand what does this DSRI means. It's like days of sales receivable index. DSRI is basically a negative number. What I mean by DSRI being a negative number, previous year 8 days was the receivable, and in the current year, let's say 10 days have been the average collection period. So obviously the situation has worsened. Now since this DSR is basically a negative parameter, the index that Beanish has tried to create over it is to have the current year figure over the previous year. So which is 10 day upon 8 day. This is going to give me a greater number, and Beanish says greater the worse. So higher the ratio, the worse it is. So that's how the Beanish has created. I'm talking basically about this slide, which is the genesis of the entire slide. This particular bullet, which is the genesis of the entire slide, says some index will have the current year's figure in numerator, and some will have the previous year's figure in numerator. Now the key is for a candidate to understand how has it been constructed. Now I'm again saying that you don't have to ratify or remember all that, but you just have to appreciate and understand that. Okay, let's take another positive index, which is a gross margin index. Now gross margin, if it is 18 in the last year and 20 in the current year, this is a positive thing. Higher the worse. So therefore the way this time he will do is he will try and create the current year performance in the denominator, because higher the worse, which means if the previous year's one was higher, then it means it is bad situation for the company. Okay, so the formula that we are choosing has got two things here. One is the let's say SGA, selling general and administrative expense. Okay, but you got to understand higher the worse, but here there is a negative sign. Okay, so compared to DSR where there was a positive thing, a negative ratio with a positive sign and a negative ratio with a negative sign are just opposite to each other. Okay, so just read through your core book and you will be easily comfortable to find out where you will have to use the current year in the numerator and where not. So let me, if I, let's say, let me exemplify that. uh, in case of days of sales receivable, the figures that he would have used is current year over previous year, because there is a positive sign. But in case of SGA, he would have still used previous year over current year, because there is a negative sign that he has attached to it. Okay, just go and read out your core books, or the books that you're referring to. It will be very easy. Just try and understand that every such thing is an index. An index has a NR and a DR. So DSR of 1 year compared with DSR of another year. Okay, this is how the structure has been created as. Okay, so like I said, Binish talks about 8 different ratios. Higher the ratio, the worse it is. Compare that with another model called Altman model, where the outcome is a Z score. Altman basically use 5 different ratios, all of the current year, so there is no comparison with the previous year. Okay, this is something that you got to remember. The second aspect that you got to remember here is that obviously you don't need to remember all 5 ratios, but you got to remember that all the ratios, the denominator is common, which is the total asset. Okay, another very important aspect, and the most differentiating aspect from Binish, is the fact that higher the ratio, the better it is. Okay, so here Altman basically tried to link things like working capital, net profit margin, sales, to total assets. So basically trying to decompose the firm's performance into different aspects. Okay, pretty straightforward, pretty interesting, these models are. So let's talk about a slide which is pretty relevant, in the current context, and I'm going to come back to this slide in my next reading as well. So this is pretty much upfront communicated to you as well. Well, the slide basically talks about that every earning, the quantity of every earning, let's say it is $100 PAT of PAT, will have some component coming out of the cash transactions. What I mean by that, it is the cash sales, it is the cash expenses, it is the other cash incomes. Okay, now obviously you are aware that an income statement is created out of the accrual component, and accrual component here has been further divided into 2 aspects. I'm going to come to that a little later, but fact of the matter is that the idea is that this $100 of PAT should be divided between the cash component versus the accrual component. This component is something which needs to be discounted by the analyst. What I'm trying to say is that this is the place which is open for manipulation. I am not saying that it has been manipulated for sure, but all I'm trying to say is that there are chances that it might be, and hence a lower weight needs to be given to this particular component. So if a particular company is showing $100, out of which $80 are coming as accrual, this is still a worst case scenario compared to a company which is, let's say, showing $95 and which is showing only 10% coming from accrual. So accrual portion is really something that as an analyst is a matter of worry for me. Now between this accrual, you can divide that into 2 aspects. There is something that is obviously very normal accrual thing. Let me give an example for that. You're operating in an industry where 2-month credit is is a general norm. So obviously as a player of the same industry, you got to give that credit. So this is normal accrual. Sometimes it's also called as non-discretionary. It is not on your choice that you can alter this. Obviously as an industry player, you will have to follow some of the industry norms. So this is still a lower problem for me. What is a greater problem for me is something called as a discretionary accrual. If let's say the company needs to really push the business, they might start giving a 3-month credit period. So the delta of 1-month credit which is given by the firm is something which might indicate scope of manipulation. Okay, so there is a very important aspect called CFO to net income ratio, which is the cash aspect divided by the accrual aspect. So overall this number should preferably not be less than 1 all throughout the life of the company. There should be some variability. It should not be consistently declining. It should remain flattish over a period of time, and obviously like mean reversion over a long period, it should remain equal to 1. Okay, Yeah, so moving to the next slide, which is basically on the different examples of earning manipulation. Not a very difficult slide to understand, at this stage of your preparation. It is basically trying to say that your PAT could be manipulated in two ways. One is the revenue side, the other one is the expense side. And honestly speaking, we have talked about most of the things, which is like the classification issue, which is the difference, let's say between operating versus non-operating, and on the other hand, which is the timing issue, which is, obviously capitalizing versus accrual. And we also talked about cash versus accrual here. The other aspect that is like a delta or the incremental value add for you at this slide is how do you manipulate your revenue. Obviously one is something that we have already covered, that if someone has to increase the EBIT, then they will take out the expenses from operating and put in the incomes into operating. So these are certain conditions that we have already talked about. But these are the three new aspects that you got to understand, and this is, please understand it up front, that these are non-sustainable increase in the sales which cannot be carried forward from year to year basis. You can really do this as a short term measure, but over a period of time, if an analyst find out that any of the three method has been resorted by the company, and therefore the revenue is jacked up, hence I'm going to call this earnings as not of good quality. What are these channel stuffing? Channel stuffing is a typical example where a company, let's say like Apple, who sells its products through distributors, distributor A, distributor B and C, and finally comes the consumer. Now this company wants to increase his sales, so rather than ensuring and kind of looking at the entire value chain, Apple really stuffed up the channel to his distributor. So this is like wholesale, and this part is the retail. So ideally speaking, wholesale should be a function of retail. You should not make your dealers very inventory heavy. But sometimes a company, in order to manipulate certain issues at their end, might want to really stuff the distribution channel in that way. So this is something, is obviously one time, because the distributor might not have the capacity to absorb this kind of an inventory risk at their end. The second is bill and hold. Now this is resorted to when the distributors really kind of raise their hands up and they say, "So sorry sir, we will not be able to take any more inventory." So what Apple does is they pass on the adjustment for credit sales. Obviously it's a bogus credit sale. They bill the product but hold it with them. So this is clearly a bogus sale, because if the sales have been done, my revenue recognition principle says that the ownership must be transferred, the risk and reward should be transferred, but you are still holding it. Therefore you are still holding the inventory and its risk. That means it is still not in substance, it is still not a sale. So this is something that is resorted to when even the distributor stop taking any more channel stuffing from them. And the third is of course is a distress signal where huge discounting is done. Let's say discounting equivalent to 70%. Now obviously this 70% will artificially create a demand and an interest in the firm's product, but obviously this is a huge selling expense that the firm cannot sustain. So any of the three, if an analyst see that the sales are increased because of any of the three things, then obviously you can conclude that the earnings are manipulated. But how would you find those things out? That's another question. Well, again, these are the tools which are available, very commonsensical. You got to do the historical analysis, you got to do the cross-functional analysis, comparison with the peers. You got to look at the cash versus accrual aspects. If someone sees that your unearned revenue is increasing considerably year after year, that means there is something incorrect with that. Okay. In some cases, the analyst may want to check the physical data, if obviously given a chance, because otherwise companies will not allow the analyst, etc., to kind of check their physical stocks. But if given a chance, they should always look at that. Imagine a stockyard where this much space is taken by one car, and you can imagine there are, let's say, only 20 cars that can be parked in this particular stockyard, but the balance sheet says that there are 200 cars being parked. So obviously you can make a sense that compared to the physical space, the number that is being shown is not correct. So there is something that you can find out in that case. And obviously the related party scanning is something that you have to be in any ways worried about as far as this particular case is concerned. So moving to the last slide of this reading, fairly simple. So where can an analyst find the risk related to the company? Obviously, annual report is one of the biggest source, and therein, you have different components like financial statements, the auditor reports, the notes to financial statements, management disclosure and analysis. I mean, these are all the commonsensical reading that must be done by the analyst in order to analyze a company qualitatively. Very, very important aspect from the analyst standpoint. And obviously, you have some other details like SEC forms NT, your newspaper, magazines, media, credit rating agencies, etc., etc. So all in all, pretty simple and qualitative reading this was, reading number 21. I hope that you guys have enjoyed. So I'm going to looking forward to speak to you in my forthcoming session on reading number 22, which is equally interesting. Again, a very, very short thing, but it will involve a little more calculation aspect. So talk to you soon then. This was Ankur from Fin Study Club. Have a great exam. Thanks.